Welcome to the Family Office Podcast, powered by FamilyOffices.com.
Hello, this is Richard Wilson with the Family Office Club, and today's webinar is on why you need a family office. Attract deals and capital partners while reducing taxes and fees. So this webinar is being created because I was face-to-face with a billionaire about 7 or 8 months ago. He asked what I did. I explained it. I told him why people like to have their own family office, and whatever came out of my mouth at that point was not good enough to convince him. He said, well, I invest all my own money. You know, I have most of what you say already in place. I don't really think I need a family office. I think he was wrong in the moment, but, you know, we were at a social gathering with about 60 people in a residential suite of a hotel, and you know, I didn't have time to go through a webinar with him on why he does, in fact, need a family office, I believe. And obviously, I could do a more concise job of summarizing it up in a single sentence. So when I also looked at what 20-some webinar topics we've covered today, I realized we've gone over how to start a family office in some detail in some of the webinars and some of our live conferences. We cover that within our book, obviously, called How to Start a Family Office. So I've never done a webinar really on all the reasons why the family office industry continues to thrive and grow despite what's happening in the economy. It grew during 2007, 8, 9, 10, and 11. It grew, recently over the past, 7 years since then. And I believe it's going to continue to grow for the next 10 or 20 years. So this webinar is going to go through exactly why, if you're worth 10 million, 30, 50 million, a couple hundred million, or several billion dollars, as many of our clients are, then this is why you need a family office. I'm going to go through the slides very quickly. It's my belief that the most valuable people that this would resonate with are the ones with the least amount of free time. So if I can, I'm going to knock this out in 15 or 20 minutes. It's probably going to go a little bit over that, but bear with me because we're going to be trying to deliver a lot of value to you per minute if this is relevant to you at all. So let's jump right into it. So first off, the core of a family office. What does it include, and what's the core reasons why people start a family office? First is the pure family office access. There's a variety of reasons that you would want it, and we're going to go over a few of those reasons, but being able to connect with other centimillionaires, billionaires, or the family office teams that protect their assets and invest them can be beneficial for many reasons. One of the top motivating factors is to do more direct investing and to have more deal flow. So traditionally, wealth management is done through a private banker. They have a platform of fund managers. If you want real estate access, they put you into a REIT or a real estate-related ETF, or you might get lucky and through a private banking division, they'll allow you to own 0.3% of a multi-billion-dollar building or portfolio of commercial real estate buildings, and that's as direct as your investments get typically with a private bank or traditional wealth management firms. So lots of people say, well, I spent my whole life creating my wealth. The last thing I want to do is now fork over 25% or 80% of it to a private banker and hope he's not going to ruin it all or lose a lot of it while charging me a lot of fees. The famous saying is that, for a lot less fees, I could lose money just as well myself, is what people often complain about. To be fair, there's some excellent private bankers and wealth management firms out there that provide even more value than what someone might get from creating their own family office. But in general, the wealth management field does a very poor job of serving the ultra-wealthy, and that's why the family office model exists. It's important to know that direct investments basically means whether you're investing in an apartment building or an operating business, it's going direct to it rather than investing through a fund in a blind pool situation where you don't know what assets or what's going on within the private equity or real estate fund portfolio. Also, you can go more direct than you could through a wealth management firm or private bank by either hiring a consultant who's going to help you choose fund managers or just going directly and hiring the fund managers which resonate with your family the best and that you get to know and really trust their team versus just choosing some on a fund management platform. Obviously, you'd want to do your due diligence on anything that we talk about in this presentation. Make sure it's appropriate for you. Make sure it's legal in the jurisdiction you're at, whether you're in Singapore, Hong Kong, Moscow, or New York. The rules are going to be a bit different and tax laws will be different. Another motivation for starting a family office, the third core reason, is reducing fees and taxes. A lot of entrepreneurs, even billionaires, are very sensitive to paying more than they should for the value that they're getting. They didn't become wealthy on accident, and if they didn't have that equation constantly in their head of what are they paying for something and what value is coming back out of it, and there being a positive ROI on that, they wouldn't be where they're at. The next, and many times tax structures, legal structures, trust and estate planning has not been looked at deep enough, at least not by somebody who's used to serving someone with 100 LLCs or worth $100 million plus, and that leads to a lot of inefficiencies and lost opportunities to save taxes. The next core reason is to align your team and reduce the amount of chaos. We're going to go into that. Another benefit is attracting capital partners to co-invest with what you're doing internally with your portfolio. And last is to have a family office dashboard, a charter document. People don't wear on the sleeve that they don't wake up in the morning and say, wow, I wish I had a family office dashboard or charter document. But they do wake up and get into the office and realize there's an enormous amount of chaos. There's a lot of things that at a very high level are very important. But if they're not written down somewhere and executed in an orderly fashion, and that the team's not all on board at a high level with where you're going and why and what to spend time on, it can get very chaotic. And we're going to be talking about that in a few minutes as well. Emulating peers is one of the first benefits I placed on the list because I think a lot of people realize that the more successful you become, the less you can listen to most of the people around you about things related to building a business or building your wealth. It can be a lonely spot if you're a CEO of a business and you're doing $50 million in revenue. You might only have 10, 20, 30 contacts, and you might only be talking to those contacts once a week or 3 or 4 times a week that have the same perspective of you of running a 200-person team or dealing with a balance sheet that large or dealing with an income tax situation where if you're not careful, it's going to look like you're earning $3 million in profit a year. So you need to find strategic ways to maybe reduce that if that's a goal and is possible. So the point here is that connecting with other family offices and people with similar problems can just be a very enjoyable process, but also a very profitable thing to focus on. You can do things like horse trade and give access to resources or research or staff or strategic operating businesses that you might be able to share benefits with each other. You might be able to provide discounted help in one area for advice and a board member spot in another area. You might be able to emulate a platform strategy that somebody is taking to a manufacturing niche and apply it to your food and beverage distribution business. You might be able to take a niche monopoly strategy of buying up all the intellectual property in a mobile phone niche or in a distribution niche or consumer product niche and see someone else doing that, and they have a roadmap now on how you could navigate and penetrate deeper within your own industry. I think this is the thing which keeps my job the most fun and interesting and dynamic, is that I get to work with some of the most successful business families in America and globally, and doing so just constantly brings fresh ideas as they tell their story of how they created their wealth, and as they tell their story about how they grew their business or acquired competitors or dominated a niche, and what they did to grow their team and their business along the way. And we're constantly listening to them and cross-pollinating ideas between the families we work with. We typically are only working with one family within a niche area, and many times the business strategies, marketing strategies, financing, use of debt strategies, the way they structure things, negotiate things, and navigate their business arena is transferable to other areas, even if it needs to be adapted, obviously, to make sense in the other area. But there's a lot of lessons to be learned between the families that you're just not going to get from someone who's maybe running a $1 million a year business. If you're running a $50 million a year business, and the strategies of a $1 billion family office are going to be very different from that of a $50 million family office. So connecting with peers in your region or in parallel industries or even in your same industry to joint venture on things that other people can never do is something that I think is very beneficial and people get right away, and that's one of the reasons why they want to start a family office. Also, a lot of family offices seek to co-invest with others for multiple reasons. One version of this is family offices who, for whatever reason, have liked going into a deal but only following someone who made their money in that industry who vets it for them. You have to be really careful on this and make sure that the person who made their money in real estate or made their money in manufacturing isn't making so much additional money on the deal by syndicating it and raising the capital that now they don't have to eat their own cooking or it de-risks the deal for them. Even though it's very intuitive that someone who's made all their money in hospitality and growing a network of owning hotels might buy a hotel, ask 3 other families to come into the deal, and they might take a management fee and a profit percentage or carry on that deal. It might seem like a very natural thing. They should be paid for their hard work. But what you have to look at really carefully is, are they putting up 60% of the capital and they just need to raise 20% or 30%? Or are they putting up 10% of the capital and they're really putting all of your capital at risk and earning most of the money off this deal, off of the deal going well, but not at their capital's expense in terms of taking the risk? So you have to look at that very closely and be very careful on that. And other forms of co-investing could be literally a straight co-investment. It could be 50-50. It's almost always not, by the way. It could be a syndication among 4 different families that bring value. But there's typically a ringleader who's found the deal, brought it, is working the deal, is leading due diligence on the deal. They might foot the due diligence expense and just get a slightly better valuation by going in first and being hard on their money first. And then maybe the other investors come in later and maybe they don't get charged a fee, but they just get a slightly higher valuation and maybe reimburse that initial party for leveraging their due diligence. That's another form of co-investing that happens. And then there's obviously family offices out there that have internal private equity funds, hedge funds, different offerings, operating businesses that are raising capital, or that run what's called an independent sponsor model, meaning they are putting up 10%, raising the rest of the capital from others. Sometimes they put up 25%, raising the rest of the capital from others, but most of the capital is coming from other parties. And that's a traditional independent sponsor model, whether that is owned by a family office or not. It's out there in the marketplace and it's very widespread at this point. But sometimes that's referred to as co-investing. So you have to really figure out what somebody means when they ask you to co-invest with them. It could be something very friendly with no fees at all, or it could be something very expensive where you're risking all your capital and they're risking almost nothing when you look at the management fees and performance fees they're getting. Another benefit of emulating your peers is getting more deal flow, and we're going to talk about how to do that and pull the levers to get the maximum deal flow that you're wanting to invest in just a couple minutes, and also positioning your family office to get very specific things. It could be introductions, it could be information for your operating businesses, it could be an edge in the marketplace in terms of your IP, your intellectual property, or your ability to scout out what competitors are doing. There's a lot of strategic benefits to having a family office. And one thing that's happening for sure, without doubt at this point, is that there's so many family offices being started. Every day there are new family offices being started that there is a huge amount of capital out there and a lot of potential capital partners, and nobody knows who to take seriously and who to spend time with and who to trust as a strategic investor. And there's so much capital that at some point, if you realize your company is valuable or that your company is profitable and you don't really need a capital partner, you'll delay bringing one on until they are a strategic capital partner. There's times when people get desperate and they get into a distressed situation, they just need capital. But many times the best investments are those where they didn't need the capital, but hey, you took your company public on the NASDAQ, you could help me with my business perhaps because it's in the same industry with your connections. We could grow this to $100 million a year from the $10 million a year we're doing now. That's one example of why someone would bring on an investor or sell 50% of their business when they're not really shopping their business. And I think that's the more valuable businesses to invest in, are the ones that are not being shopped. If the business is being shopped, they might say, oh, well, this is just comes to a transition point and, the whole point was to build this and sell it in 7 years, and that might sound like a nice story, but you don't know if behind the scenes, if they're getting squeezed on their margins, if their key staff are all about to walk out the door, if they have several pending lawsuits that aren't formalized yet, so they might not be disclosed in due diligence, but they know there's lawsuit risk out there. You don't know why they're really selling. You never really do. You have to figure that out through due diligence. And my point of saying that is that as more family offices come out there, CEOs, real estate asset owners, people who need capital and have valuable deal flow, that 1% of deal flow that you actually want to spend time looking at, those people have their pick of who they're going to allow on their cap table, who they're going to sell to, and they'll oftentimes pick someone who's strategic and is going to be a good steward of the business, especially if they're going to be hanging on to equity, rather than just the highest price. Because some of their wealth is in your control at that point. So the picture here, if you're watching along visually, is of a cereal aisle, and when someone's walking down the aisle and looking at what family office, what private equity fund, what publicly traded company they should sell their assets to, you want them to choose you. And we're going to go through exactly how you can make it so that the deal flow you want comes to you naturally and more often than it does right now using your family office. And I call this having a unique capital proposition. Just like a unique selling proposition when you're selling a product, you have to have something unique that comes with your capital. If your capital is just capital, they could go to the bank or they could just go to the highest bidder. And you have to be different. You might have to be the highest bidder on a deal that you love sometimes, but the goal is to be the only bidder much of the time for deals that you're looking at. If you're a fan of Jim Collins and his Good to Great book, you might recognize this diagram of the hedgehog strategy. And many times when families look at where they created their wealth and then set up a family office, they end up investing back into the space where they made their wealth. It's a natural thing. That might make up 20% of their portfolio, or it might make up 80%. A lot of families also put 25% of their assets in real estate unless they had created all their wealth in real estate, and sometimes it's more. Again, it has to be appropriate for the family's risks, and you need to do a very careful job of going through about 70 different questions to determine these things. But the point of bringing this up is that when you try to figure out what your family office is going to be focused on, I would decide this based on these three circles and the intersection of them, which Jim Collins calls a hedgehog strategy, which is what's your family passionate about? What do you want to spend time on every day? What do you want to get up in the morning doing? What you can be the best in the world at and beat all the competition at because of your DNA, your history, your experience, your knowledge, your relationships, your distribution, your networks, your unique abilities. And then what's really going to be something very profitable to do. There's 100 things you could do. There's maybe 10 things you could do that you're passionate about and you could be best of the world at. But out of those 10 things you could do, what's the one or two things that are really going to be highly profitable and defendable over time? And that's perhaps what you should focus on. The next slide here, if you're watching visually, is just a picture of Warren Buffett. And my favorite quote from him is that sometimes the tide matters more than the swimmers. In other words, when you're looking at the 10 ideas that you could focus on and figuring out which one or two would be more profitable, I would strongly encourage you to figure out where the tide is flowing. And even if it's just a trickle at this point, to position yourself there so that as the tide rises in that area and as the flow increases, you're going to be positioned well and the business is coming towards you versus you chasing a market which is already mature. Unless you can identify a niche and carve out a niche that's new and growing or unclaimed by somebody in a big market, then I would go after a segment of a market or a new market that isn't already dominated by publicly traded companies and billion-dollar families already. And so I would definitely keep that in mind when trying to figure out the focus of your family office's portfolio, at least the operating business or the real estate strategy side of it, which I think is the fun side, and that should be addressed. I mean, in a portfolio for some families, you might want to have X% to the public markets or public market exposure. You might want to have Y% to real estate and Z% to operating businesses. Wherever you created your wealth, or you're going to personally be most involved in creating new wealth and protecting your wealth through strategy that you're going to be deploying through yourself and your family members and your team, that's a lot of what we're talking about here today. That's why people create a family office. Typically, most people don't create a family office to have complete diversification where they only have a 1%, 2% allocation to all different markets, all different asset types, and without any focus on really doing a great job and getting outsized returns in one or two areas. Most families do have that focus and appreciate that diversity has its place in the portfolio at the same time. I'm not preaching not to diversify, and I'm not saying that you should diversify. There is no advice that's right for every family, but these are some of the trends I've seen when families create a family office. They typically want more direct investment deal flow, and they want to propel their wealth while protecting it, like offense is the best defense mentality, because they feel like they can manage the downside risks because they know their space very well and achieve outsized returns at the same time. Another way of looking at this Warren Buffett quote of the tides matter more than the swimmers sometimes is basically, looking at the CEO of Under Armour. He talks about focusing on inevitabilities and expediting those. So figure out where a market is going and jump ahead of where people are at. If in your market you're raising capital for a real estate fund and some competition are cutting their management fee and they're charging 1 in 20 instead of 2 in 20, maybe you should just go and do 0 in 25, charging no management fee, get ahead of the curve, raise capital faster, et cetera. It's just one example. In every industry, there's trends. If you can get ahead of the trend by a half turn or a turn or two, that's often enough to have a distinct advantage in the marketplace. One of my favorite business coaches is Dan Sullivan, and my favorite concept by him is unique ability. And I think this applies at the organizational level for family offices. And the concept is essentially, if you look at what you are very good at in your special skill sets, and you try to craft it so that each person on your team knows what that is for them, but then as an organization as well, as an organization, you're focused on the thing that you are best at, and you outsource everything else to the degree that's realistic and possible, that you still have transparency and control, then I think that can be something that can be great for forming a very lean virtual family office. Meaning, yesterday I was on the phone with a multi-billion-dollar single-family office whose name you would recognize, and I was talking to the CEO, and they said they have 3 people on the team. Everything else is outsourced. Yesterday, earlier in the day, I was on the phone with a $160 million net worth first-generation family from here in the U.S. as well, and they as well only have 2 people running their virtual single-family office. Everything else is outsourced. I also have clients that are only at $200-300 million, and they have a dozen clients at the family office level, or 100, not clients, but 100 people on their team, professionals on their family office team. So there's different approaches, and you might define what your unique ability is and translate that differently into how you operate your family office. But at least being aware of where the majority of your team's resources should be focused to get you the best return on their time every day, I think is an important concept. And it brings up the point that many times, if you're listening to this because you need a family office for yourself, or you think you might need one, at some point you probably had to do everything in your business. And unless you were well-funded from the beginning and you spun out of Goldman Sachs and started a fund or got funded early on in the VC world or something, most of us had to roll up our sleeves and work 14 hours a day to hire the first employee, then hire the next, and hire the next. And at some point of having 2 to 5 employees, you realize you have to work on the business instead of in the business. And then you have that revelation, and the business grows faster. The same thing happens, I think, when someone has a liquidity event, or they get to the point where they're producing $2 to $3 million a year in profits in their business for several years on end. You get to the point where you realize that instead of working on your business, you're naturally starting to work on your businesses. And then you need to evolve to the point where you're working on the system which manages your portfolio of businesses. So that is working on your family office. The best way to summarize the family office is just holistic management of everything that touches your balance sheet, and working at the system level of how those all interact with each other and help each other grow and defend each other in the marketplace is really what a family office is all about. So on this next slide is a pretty detailed one. If you're not following along visually, I'll summarize it. But essentially, it's an example of a unique ability of our team. Our strength has been a decade of positioning and developing our brand, the Family Office Club, within the family office space. Everything from writing 3 books on the space, to having the #1 podcast, to having familyoffices.com as the most visited website in the industry, and holding 71 conferences. It'll be in about 3 weeks here at our next event. And so this slide, if you're following along, shows 44 different business development maneuvers you can take to positioning a brand and attracting clients and attracting customers. So when we run an operating business, we go through this list of 44 different things that you can do to propel a business forward. And our unique ability is using these strategies to attract a deal flow and attract clients or investors for something. So we get the attention of people in the world, whether it's someone with a piece of deal flow or someone with capital or someone who is a family office. And that is our unique ability. That's how we maneuver the landscape and move faster than our competition to get things done. So as a family office, you might find that it's your financing, your abilities to use debt, or your ability to structure or negotiate deals, or your ability to identify spin-off opportunities from publicly traded companies, and working with the large balance sheets and acquisition funds that are available through publicly traded companies might be your unique ability. It's unique to each family. Many times it's very industry specific. My industry happens to be the family office space, but I just wanted to show this list transparently just to give the genuine insight on what we see as our unique ability, and hopefully this resonates with something that you guys have internally, whether it's navigating distribution networks or creating and launching new products, etc. One thing I wanted to go into a little bit deeper is just the great need to have superior deal flow than what you would have if you did not have a family office in place. This is one of the most important parts of this presentation, because most families out there that are worth $100 million plus have very poor deal flow. and they might be seeing 20 deals, 50 deals, or 400 deals a year. They might be part of some accredited investor or some $10 million net worth minimum type investor networks, and they might think they're seeing a lot of deals through that, but still you're probably limited to a couple hundred deals a year. And the reality is, any type of network that you didn't build yourself and that isn't coming directly to you to show you deals, it's going to be generic deal flow. It doesn't matter if you're in a network of $10 million net worth people, or if you just go to family office club conferences, or if you just go to local angel investor type events, it's going to be generic deal flow. So you'll want to look at your unique ability, the goal of your family office, where you made your money, the percentages of what the ideal portfolio makeup would be for you going forward, and then align all of that with the positioning of your family office. Most people don't think about having your brand of your family office not only protect your privacy, but sweat for you. What I mean by that is that you could call your family office Wilson Family Office, and it's close to worthless because no one knows what deals to send you. No one knows what your strategic expertise is. Nobody gains anything by reading the words Wilson Family Office, besides at least knowing that you have a family office and that you might be a capital source for them for something. But it's a lot more powerful if you name your family office off of a niche industry, like the biotech family office, and all you do is invest the majority of your funds in biotech. That's going to sweat for you because people are going to say, oh, have you heard of the biotech family office? Or they're going to look on Google and type in biotech family offices, and you're going to come up first. You might get quoted in the news, and your comment could be on anything, but as you get quoted as, oh, it's Richard Wilson from the biotech family office, you're communicating to people, send me biotech deals. If you're a biotech family, we could work together. We could co-invest together. And if you're looking to invest in biotech, maybe you want to follow what we're doing and have lunch with us and discuss how we could work together strategically. There's so many reasons why that can work for you, and it protects your identity too. You don't have to use your last name. Have the name of your family office sweat for you. Almost nobody does this, and lots of people don't get it when I say they should do it. People get hung up on multiple things. One is having a website at all, but they're scared of privacy, and when you brand it right so it's sweating for you, you don't have to worry about the privacy. You don't have to say the exact assets and your exact dollar net worth. You could use ballpark figures or anonymous type descriptions of your assets and say what industries they're in and what size they are and what types of products they make. Also, I would stress that many people get hung up on the fact that, we can't call ourselves a biotech family office because we sometimes invest in pharma. Every now and then we invest in technology. It just doesn't represent us truly. You have to really get past the fact that you might invest in apartment buildings and a little bit of high tech and a little bit of consumer products, but if what you want to attract from the world is biotech, and if biotech is 60% of your energy or 50% and everything else is 5 or 10% each, you have to decide whether you want to be that generic family office out there with a boring name and no one's going to think of you first and no one's going to think of you most often for your most valued type of deal flow you want to attract, or do you want to have it really sweat for you and wear on your sleeve, hey, we're the biotech family office. If you want one page of your website that actually shows you are open to other ideas, so counterparties can see that could be a healthy thing to do, but it's much stronger to be known for something and be shown a deal first or the only one shown a deal, or get that biotech entrepreneur to respond to your email while ignoring everybody else, and get opportunities other people just are not going to get. And that gets missed by a lot of the family offices I work with, even clients that have me on several $1,000s a month of retainer, just completely don't buy into this idea, but it's going to be happening more and more because the space gets more crowded. And if you can describe your strategic capital advantage in the marketplace just by the name of your family office, it's a huge advantage over those that are too lazy to put the thought into that or non-committal to put a stake in the ground and say, this is what our family office is focused on. Could be a DBA or it could be your formal family office entity name. I want to also note you'll get sometimes double the response rate I found while reaching out to potential acquisition targets. If you reach out to biotech companies and they know you're the biotech family office, they're going to look at who you are more often, and they're going to take a meeting with you more quickly. I also think you'll just connect more fluidly with publicly traded companies, other family office peers, and it just makes everything a lot easier when you don't have to explain what you do, and right off the cuff, people get it. I want to show this next slide, which basically is a Venn diagram showing geography, industry, the dollar check size, the multiple on the valuation you'll pay or you're open to paying, the team that you require to have in place when you're looking at deal flow, whether you require control when you're investing or not, meaning 50 or 51% or more or a controlling stake if all the other shareholders are very minority and you have the most votes, and then how credible that deal is in terms of where you got it from and how credible the company is and how well known they are. The reason I have all these aspects up here is there's actually about 50 different variables to consider, but these are some of the top 7 to 8 ones that really are important to get documented. Because if you don't know these things, your team is going to be all over the place. You're going to feel like you yourself might be all over the place looking at all different types of deal flow. When if you really think about your values and objectives and mission as a family office, you might realize that the geography, it has to be Florida. The industry, 80% of the time, it has to be manufacturing. The size needs to be $500,000 in profits to $3 million in profits a year, or whatever size is appropriate for you. My point is on each of these checkpoints, you need to make sure that you know what the answer is, that your team doesn't send you deals that are a waste of time, that counterparties don't, and then wear this on the sleeve and tell people this is what we're looking for. Only in these 1 or 2 industries, only that meet these 7 criteria or these 15 criteria, and it'll save you a ton of time and you'll get much higher quality deal flow. One picture I have here that I show at some of the training boot camps that we offer at Family Office Club is 2 grizzly bears at a waterfall, and basically, the analogy of, you could go out trying to find deals in a lake with a spear, or you could go and figure out where those deals are swarming towards and have them jump into your mouth. In other words, you could go out and try to find biotech deals, or you can position yourself so that they're hunting you down and they're looking online for biotech investors and they find you because of how you've named your family office. So the whole point is to leverage the family office entity to attract capital partners, to attract a deal flow, and to reduce chaos, fees, and taxes at the same time. There's a picture on the screen now, if you're just listening audio-wise through our podcast, of different ways to attract quality deals. I believe being in different communities, like I live on the island of Key Biscayne, which is a wealthy community just 10 minutes from downtown Miami. There's positioning. That could be the name of your family office. There's proactive reach-outs. That's leveraging the credibility of the name of your family office and the strike zone that you can communicate on what you want to invest in, and being proactively reaching out to assets you want to acquire. Also, I have choke points. We don't have time to go deep into this. I've done a whole webinar on choke points, but that basically means acquiring strategic bottlenecks in your industry. They're going to bring you deal flow and bring you capital partners and bring you business to your operating businesses and just give you momentum moving forward. And then the final point of attracting deal flow is operating within the business. Even if your intent is to be an excellent investment manager in an area, operating within that same industry is going to give you boots on the ground information, a competitive edge on information and trends going on in the industry. And I see that if you combine communities, positioning, proactive reach outs, acquiring choke points, and operating within the business field you're trying to invest in, you can get much higher quality deals than if you just do proactive reach outs or you just use your network of peer investors that you have in your city. It goes a lot slower that way, and you create good luck by doing these 5 things to create better deal flow. One thing I want to spend a couple minutes on, but I'll probably go through on a whole separate webinar at some point, is just reducing chaos and having a charter document or having a management dashboard in place for your family office. It lowers stress, it minimizes chaos, it minimizes mistakes, it helps align your team, it shows what the mission, goals, and objectives of your organization are. Then for each type of asset you invest in, it'll have a separate silo within your management dashboard, so that for real estate assets, it might be broken down into apartments and self-storage. And under apartments, you might have your current assets, what the debt load and payments are, the recent NOI calculations on that, next things that needs to be done on that property to manage it, but then also deal flow that you're looking at related to apartment buildings. So you can order that deal flow, and you might be looking at 9 different deals. What stage is each of those at? And how serious are you on each of those deals, and how vetted have they been, and where should your time be invested? Because someone on your team might be able to do the very basic vetting, and then you might want to be spending your personal time on things that have passed the first 3 layers of vetting, and now you need to go see it in person and confirm that the numbers look right based on your analyst research. And I think having a charter document or dashboard in place is absolutely required. If you do not have one in place, you are losing time and adding stress to your life if you're running a family office without a dashboard, because it literally costs nothing but your time to put it in place. And every, I think, 1 minute you put into this, you're probably saving yourself at least 5 or 10 minutes of wasted time and energy on your team and for yourself, and that really means just wasted money as well if you're running an expensive team for your family office. So this is a mechanical, iterative process of walking through what you want, why you want it, documenting that so everyone on your team and all counterparties know that. Having this document be very confidential, of course, but then documenting your current assets, your current service providers, current deal flow, and documenting what you want to improve in the system each month. This is basically a documentation of the existing system and then documenting what are the next steps to make the system better, make it stronger, more robust, make it anti-fragile, make it more dynamic so that your family office's assets will be protected and structured properly, but also grown in the way you want them to. Another huge advantage of having a family office is the reduction of fees and taxes. Obviously, just putting the family office together doesn't automatically reduce your fees and taxes, but that is a big motivation of doing it, which is what we're talking about here today. And many times it happens because you have service providers that were built for the mass affluent still in place. You're now ultra wealthy. You need to get family office service providers. The people working with you don't know what a family office is, fire them and work with someone who only works with family offices or works with a ton of them. You don't want to be their learning curve on how to deal with having 100 LLCs or how to deal with having multi-generational wealth transfer challenges. You want to work with someone who deals with that all day long, and they have for the past 10 years. You also don't want to have outdated, non-optimal legal and trust structures. Laws and opportunities in this area change all of the time. Then you want to work with someone who's experienced enough to explain to you, do you want to do something down route A, which is very clean and white glove? Do you want to do something B, which is a little bit more gray, or do you want to be aggressive and know how to navigate each of those areas fluidly for you and do something that's in line with the risks and the preferences that you have for structuring your legal structures and your trust and estate planning projects? I also think that the other reason why mistakes happen on taxes is just that it becomes so much more important as you become wealthier. That 1% mistake, that 5% mistake, could pay for your whole family office for the next 3 years. And that family office could also help you save fees, also help you get better deal flow, also make you less stressed out and have chaos managed more. And whatever level of stress or chaos you have, it'll be reduced by having a formalized family office in place, is what I've found over and over again. It's something not talked about. People love to talk about their good investments and their great co-investments and their amazing IRRs. But the reality is there's a lot of chaos that goes on with being worth $100 million or more. And people internally, whether they wear it on their sleeve or not, are looking to reduce that so they can focus energy on being more effective. Every business owner wants that, and each of my clients want that as well. And there's several key ways that a virtual family office can save you money on fees, not just taxes. We hinted at some of them earlier, like having more direct investments instead of going through a fund. You can also, when you're not going through a private bank that has a fund management platform, if you're going directly to a fund manager, you can negotiate hard on fees often. They might be saying they charge 2 and 20, but they might take 0 and 10. And I've had fund managers tell me that, oh yeah, well, we charge 1%, but if somebody asked us to, we would charge a performance fee only against a benchmark or on an absolute return basis. And most family offices don't know how much leverage they have, and you're not going to find out if you're going through a private bank that's negotiated for you and charging multiple layers of fees on top of not being able to negotiate the fees directly. A family office should pay for itself just in the fees you save, not to mention the taxes you'll hopefully save, not to mention the additional deal flow, the peer insights, the additional strategies, the better planning and communication among your team. There's so many benefits on just protecting your downside on costs, fees, and taxes. That alone should make you want to start a family office. Also, one benefit of having a family office in place is just having somebody to say no for you. When your brother-in-law comes to you for capital, your roommate from college, etc., you can say, well, let me have my family office take a look at that for me, and we'll see if it's in line with our current mandate. And then if it's not, it's not, and it becomes an objective decision instead of a emotional, personal one. I'm now going to go through a couple quick case studies, and I wrap it up just in the next 3 to 5 minutes. This went a little bit longer than I intended, and I want to keep it short. These are examples of family offices that we are helping operate or that we're serving as clients in one way or another. I've got a list here. If you're looking at the slide, and I run through just a couple examples of them. I've got 10 client examples on here. One is we're helping start and formalize a $2 billion family office here in Fort Lauderdale currently. They had never formalized it before, and they want additional direct investment deal flow. Another example is a medical family. They're worth about $50 million. They're looking for deal flow just in the healthcare space. Another example is a 47-year-old who sold his business so a private equity firm. Now he's looking to invest mostly in real estate or an operating business in one specific industry that he's chosen. And we've helped set up some branding and positioning to help him attract deal flow, and it has. Usually 2 to 5 times a week we're getting deal flow we'd never see otherwise if it wasn't for the branding of that family office. One of our newest clients is a pair of brothers worth about $30 million, made their money in real estate, and they said they've heard of this concept, they read my book, How to Start a Family Office, and they want to now get started and get that done. So we're just drafting the contract for them now. And one group that we just signed a contract with recently is a $150 million net worth single family office, and their goal is really to be able to work with other family offices more fluidly is their number one goal. They have a lot of deal flow, they've done well investing the money to date, but they just want to professionalize the visibility and their peer network, and that's more important for them. So I wanted to show these examples because everything in this presentation comes from clients I've worked with and experiences and going through their portfolios and looking at their balance sheets and structuring their family offices. And I think that's important to know. I was going to start out with this slide, but I just wanted to jump right into the benefits of starting a family office before, going through this, which, if I don't show it in the right light, it just kind of looks like I'm trying to brag right out of the gates. And really, I want it to be just examples and case studies. One example of the choke point concept I mentioned earlier was one of my clients that had a product very similar to this. I switched it to a different industry, but essentially, you imagine that a billionaire has a coconut water brand. They want to get out in the industry, and they've made their money in the drink distribution business. They could do things, acquire choke points that give them a competitive advantage in the marketplace that other operating businesses don't have. They could go and start or buy the #1 food and drink expo in the industry, and that might be a profitable operating business, but approaching it with the platform strategy mindset and seeing that expo as a choke point to get the attention of distribution partners for their coconut water business is strategic. So you're getting extra profit from owning that expo business that the just expo business guy who's been running it for 20 years doesn't get because he doesn't have a portfolio of food businesses to push through. This also helps when negotiating with the next, coconut water like acai drink that you might want to acquire and then grow. You go to them and say, hey, look, we own the #1 expo. We own this magazine called Drinks Magazine. We have a database of 3,000 distributors. Let us buy half your company. We're going to grow it like crazy. I know you think you're worth 3 times profits. We only pay 2.5 times. Trust me, it's worth it. The pie is going to get much bigger, and XYZ is going to happen by this date. Otherwise, we pay you that other half turn on the valuation if we can't, triple your business in the next 5 years, et cetera. So the point here is to show you get big momentum at the family office by playing in a niche that's very focused, or by growing a platform business where your operating businesses can feed off of each other, cross-sell to each other, upsell to each other. And I find that is something people get really excited about and has a great ROI for the amount of energy you put into thinking through such things and planning them out. And it's something that I work with my clients on. We help with strategizing on this, but then also sourcing the deal flow from our 10 conferences a year through the Family Office Club and our podcasts. Some days we get 150 to 175 incoming phone calls each day to our 17-person team. And some days we get well over 700, well over 1,000 emails in a single day. A lot of members of my team are just responding to the messages that are always coming in, and that's how we source so much deal flow. Another example we don't have time to go through in depth is a family I know that wanted to pick up mineral rights equity stakes and royalties. So they bought a surveying airplane to do seismic surveys, and they basically went to these mineral rights owners and said, we'll survey your land. Then anything that you can get for mineral rights extraction from the areas we find through use of our expensive surveying equipment, we would like a royalty on those minerals extracted. They were able to do this, and by buying one asset, the airplane and the seismic survey equipment, they were able to pick up many equity assets and pick up a lot of capital and net worth because they strategically used one asset that was a bottleneck in the industry because it was too expensive for a lot of these landowners to survey their land and figure out where the minerals were laying. So this is a really smart play by them, and it's an example of a choke point strategy. Another example is a client, I created a single family office for called the Miami Family Office. If you search Miami Family Office in Google, last time I checked at least, we had 7 out of 10 Google search results. And that really helps us get deal flow. People who come into Miami looking to meet with family offices find us all the time. Just today we got a piece of deal flow because of this. And we consistently are having this brand sweat for us at no cost. Another example is our family office club itself. Like I said, it's the most fun part of what I've been doing over the past decade. We have 1,500 family offices registered with us. I've met with over 1,000 face-to-face. And what's come of that is me realizing that our value is not in providing family office startup consulting services. Our value is not in providing a family office conference or a family office database or family office, certification and training program. We do some of those things, but the value is really in being a platform for the whole industry becoming more efficient and connecting people to each other and to resources that help them more effectively navigate the industry. So the Family Office Club is a center point for that, and I treat it like a platform business. So if we want to start an executive search business, we bought FamilyOfficeExecutiveSearch.com. We got a 20-year veteran in executive search. We give them a percentage of upside in the business. We bought FamilyOfficeJobs.com and made it the #1 job board in the industry. And then we leverage our 103,000-person LinkedIn group on family offices and our 500,000 email opt-ins and our conferences to have a huge talent database so that we can do executive search work in the family office space. And that didn't cost us very much to launch. If someone was to go out and launch a family office executive search firm from scratch, it would cost a whole lot more than what we did by doing so 2 years ago or 3 years ago now. And it would be less effective because you don't have the conferences every month. You don't have the email opt-in list. You don't have FamilyOffices.com or the big LinkedIn group, et cetera. So my point is that you really can do things faster at a lower cost and at more effectively when you have a platform strategy. And we're doing it every day. And it's fun to do because it works well. Some required reading is a book called How to Start a Family Office. If you want a more thorough book on the single family office industry, I would encourage you to pick up my other book called The Single Family Office. And if you want to read How to Start a Family Office, that book, it's got a blue cover with the blueprints of a castle on the front of it and our family crest. And I can send it to you for free if you email me at richard@familyoffices.com. It's richard@familyoffices.com. And I'll email you the book in PDF format, or you can buy a copy on Amazon. We priced it as cheap as they would allow us to, and then they will print that paperback book out for you and ship it to you, of course, if you want to buy it there. And if you'd like to reach out directly to me, please do if you're looking to start a family office. My phone number is 305-333-1155. Email is richard@familyoffices.com, as I just stated. And we're based on the island of Key Biscayne, just out of the city of Miami. And I hope this presentation helped. If you're looking to start a family office, but you're not sure if you should, you're not sure if you have one already, you don't know why people are getting in a fuss about this family office idea, or you just don't know how much you should be investing in the idea, either with your time and energy or with capital, then I hope you found this webinar, very helpful. I'm going to be sending it to some of our clients and potential clients, and feel free to reach out with questions you have or frustrations or bottlenecks to helping you get started. If you want to see exactly how we work with clients, the best thing to do is reach out directly to me, but we have some of those details on our website, singlefamilyoffices.com as well. So thank you for your time. This is Richard C. Wilson from the Family Office Club, and we'll hopefully see you at our next live Family Office Club event. Take care.
Thank you for listening to this edition of the Family Office Podcast, powered by FamilyOffices.com.